Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, the Senior Market Specialist at FXCM. My email address r@fxcm.com, and of course, I would encourage anyone who wants to send me an email to send it through to me, and I'll reply as soon as possible. Today's Friday, the 8th of April, 2022. Also, just want to do a sort of a sound check. Can you guys hear me okay? Just because I am hotspotting at the moment, so I just want to make sure. All right, cool. So just let me know if there's any issues with that. Hey, Joachim, Michael, Raj, Howard, pleasure to have you on the webinar. Thank you, everyone, for joining this morning. I appreciate it. I'm just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. And here's our commentaries disclaimer. Just keep this on screen as well. Okay, and just lastly, references. So the analysis, the technical analysis we're doing MarketScope 2.0. We're going to read the CNBC.com morning note, and we may refer to tradingview.com. Yesterday we brought up trading economics, which wasn't in our references, so depending how the webinar goes, we may have others, but these are the three references that I usually sort of consult. All right, let's bring up the chart, but just before we get into the chart analysis, I think it's worth a while just going through the morning note, which is from CNBC, and it reads as follows. The headline: European market set to climb to end volatile week with Fed plans and Russia in focus. And European markets are expected to advance on Friday's open to end a volatile trading week as investors assess the pace of the Federal Reserve's monetary tightening plans and news from Ukraine. The Pan-European Stock 600 index closed slightly lower on Thursday, despite having been up around 0.8% at one stage, as volatility continued following details of the Fed's plans to tighten its balance sheet and hike interest rates to contain runaway inflation. The US Congress has voted to revoke Russia's trade status and ban oil and gas imports, along with banning all new investment in the country and sanctioning President Vladimir Putin's daughters after reports of rape and torture against civilians by Russian forces in Ukraine. The atrocities drew condemnation from the G7 members, who voted to remove Russia from the UN Human Rights Council. Ukrainian Foreign Minister Kuleba met with G7 and NATO leaders in Brussels to discuss weapons supply to Ukraine. The European Union has also approved new sanctions against Russia, including a landmark embargo on Russian coal imports. Investors worldwide are also keeping an eye on the fallout from China's tight COVID-19 controls as it battles another surge in cases, potentially further disrupting global supply chains. Markets in Asia Pacific gave up early gains to mostly pull back on Friday, losing overnight momentum from a comeback on Wall Street as investors continue to monitor the Fed's plans to fight inflation. US stock futures were little changed in early pre-market trade after the major averages staged a late day comeback on Thursday. All right, so that's the CNBC note. Let's just see if we can pick up some sort of inference from the chart. In terms of sentiment. So this is the line studies we were doing yesterday. This is the DAX 30 weekly, and it's pulled back to the 62% retracement. Again, I don't want to imply that these fib levels have any sort of magical qualities. They don't. Okay, you'll have a hard time convincing me that they do, but but they are watched as traders. We watch the 62% pullback in particular. So it becomes a self-fulfilling prophecy. In other words, there could be a whole number of market participants looking at the 62% level to short. And if the majority of the market decides this is a perfect time to short, well, then the 62% retracement becomes meaningful, right? Because that's the level we're all taking our action point off. So that's the way I use it. Just not really to say, well, this is a Fibonacci ratio. It's you can work out golden ratios with it. I think that's all nonsense. The point is that it's used by a lot of technical traders, and it becomes self-fulfilling. So that is the first thing that we have to acknowledge. The second thing that we have to acknowledge, which is more meaningful than a fib, is actual support and resistance. Because support and resistance, well, at least there's some sense to that. So we've gone up to a support turned resistance level. So if we just have to explain sort of the psychology behind support and resistance, the idea here is that whoever bought there whoever went long made money. Okay, it came back down. The same traders probably thought, it's come back to a good level. We made money last time. Let's buy again. Let's buy again. Let's buy again. At the same time, anybody that shorted here made losses almost instantly. So if it comes back, they cover their positions. Well, you cover positions by buying. So that's what support is. Okay, that's what support is. Now, eventually, what happens is we break that level, and as we move far away from it, so whoever went long here, well, now they're holding significant losses. They would sell out. There's the selling pressure. Whoever went short here, well, they likely say, well, last time we made good money, we're back at these levels. It's time to short again. And then those are just two of three sides. The third side is the uncommitted. So the guys that say, well, this was a really good time to be shorting, well, they could be adding some pressure here. So we've got price support turned resistance over a fib level. So there's a confluence there. And that's what the DAX is up against on a technical basis. On a fundamental basis, it's up against extremely uncertain environment. Uncertainty is the definition of risk, and if there is a heightened risk, market participants generally are what we refer to as risk averse. That means to convince a market participant that it's time to commit some capital, well, you have to entice them with the prospect of a higher reward and a higher R. So, and that news is constantly in flux. Okay, every day we read the morning note, it's got something different and some more uncertainty, and there's some flux there, and that is probably disrupting a trade right as we get to that 62% retracement. So there's a sort of almost a triple confluence. One of the double confluence on a technical basis, the third confluence on a fundamental basis. Now, that's what we're dealing with. I think the supply shocks that we have been mentioning still have a course to run. I don't think we've seen the full brunt of these supply shocks, and that's something that we certainly want to keep our eye on, because it's going to make the implementation of monetary policy more difficult. We have spoken about it previously. We will talk about it again in more detail next week. But right now, I think that the likelihood of the Fed being as aggressive as they want might be a policy mistake, and we just got to try and see if that's what the market thinks as well. So we at the 62%. What does that mean in terms of sentiment? Well, it really comes down to this: uncertainty. Okay, so uncertainty is risk. Now, let's just take off the fib, and let's take off the resistance, and let's even take off this, and let's just get a raw understanding of what's happening over the last 2 weeks, because we're at the end of the week, right? We're 80% of the way through the trading week. I think we can combine these two. The caveat is that, of course, this is not a complete candle. We'll only know what this candle looks like at the end of the trading day, but I think we've got enough to work with to get an idea of what's the market sentiment at that 62% level. So we're going to combine last week's and we're going to combine this week's. And the way we do that, let's just zoom in here so we can do it with a little bit more clarity. So I'm going to take last week's high. I'm going to take the high of the two, so which would be last week's high, it would be this week's low. And I'm going to just draw a range. So drawing a range down like that. Okay, represents the range. I'm going to just change this color to red. You'll see why in a moment. Okay, so that's the range over the last 2 weeks. Where did we open last week? We opened here. Okay, so where was the open for the two periods? Well, the open must be at the first candle. So the open's over here. So let's just pop in the open, which is over here. Okay. If anybody's not getting this, you must let me know, because it's a really useful tool to measure the sentiment. But where's the close? Well, the close is actually lower, right? The close is lower, which must be this week's current price action. Caveat, remember that the close may change drastically between now and close of business. Just remember that. So we don't have a completed candle to work with, but what do we have here? What do we have here? What kind of candle is this? Okay, so this is actually a bar. I'm going to turn it into a candle now, just to make it easy for us. Okay, and we're going to have to turn it red because we're down over the week, right? We're down over the 2 week period. So let's just make this red, and that sort of helps a lot. So if we just ignore the last 2 weeks and we take a look at this candle here, what kind of candle is that? And you guys can see, well, it's a doji or it's a spinning top. What is a doji? What is a spinning top? They're candles of uncertainty. You've got bulls that have tried to take price up, that hit the 62% and it's retraced. You've got bears that have tried to take price down. They've actually been met with some support, right? Because you can see that the idea here is we've got a bit of a support tail there. Raj just saying we short DAX. So we'll talk about that. I think again, Raj, obviously I can't give buy or sell advice. I must be very clear on that. But what we'll do is we'll just make the inference from the charts. So if we had to say what's happening here, what we can say at the very least is that there's a candle of uncertainty over the last 2 weeks. That makes sense because we know we're in an uncertain environment. The question is, do the bulls have the power to move above that 62%, or are the bears going to be targeting that 62% and take price lower? And that's the challenge where we are now. Currently, we do have, I think my assessment of the situation is that there does seem to be a bearish bias to it. Why? Because we do have a slightly longer selling tail. However, we must acknowledge here, Raj, there is some support. So just be aware of that. There is some support. So just make sure your risk measures are in. You must have your stop loss in. You must have that money management in. I was, just to let you guys know, I've been short euro. I think I just closed my euro short this morning, but I went short at least twice this week. But I have closed it. Now, so you can see we've got this uncertain. You've got this uncertain field here. Now, let's just take a look at this in terms of how bearish is this chart. So again, if there's any questions about this, you guys must let me know. I'm going to add the fibs back in. Let's just, okay, I just want to draw this back down. Yeah, let's just put the fib back in. Okay, I usually just have a 50 here. I don't usually have the full fib levels, but I just want to make this. I want to change that 50 to a 62. Okay. All right. So this is the fib now. Now take a look. Forget about the two candles. Forget about if we can kind of even try and blot this out. I'm not even sure if we can. Let me just try and put a black blotter here. See if that. Okay, so just forget about the candles inside this black rectangle. Just take a look at the candle we've drawn. Just take a look at the candle we've drawn over the last 2 weeks. So we're at that 62% uncertainty. How this plays out now is key. Okay, how this plays out is key. So we're at a very strong, I would suggest, psychological level. Is Pete on this? I don't think Pete's on this call. Pete's not on the call, but he said 14.8. He's looking at 14.8 as his resistance. I would also suggest above 14.8, you've got 15. 15 is a round number. Round numbers tend to be psychological resistance or support. Okay, so we've got that. We've got the 62%, and we've got the polarity principle. What's the polarity principle? Oh, sorry, I didn't mean to do that. The polarity principle is simply support turning resistance. It's support turning resistance. So there is a lot for bulls to overcome here. There's a lot for bulls to overcome here. Nevertheless, there is a little bit of support that does seem to be manifesting. So just keep that in mind. Now, let's just carry on with the weekly, and we're going to go down to the daily in a moment. Let's clear these out. I'm going to clear out this everything we've drawn. I want to just now do a reference candle. I want to do a reference candle analysis. Okay, so let's zoom in here again. Okay, so what's a reference candle? Let's just understand what a reference candle is, and we're looking specifically at a bearish reference candle here. So a reference candle is at least 3 candles. Is at least 3 candles, and the reference candle, a bearish reference candle, would be the highest high in at least a 3 candle cluster. We've got that. We've got that. So that's condition 1. Okay, last week's candle is the reference candle side. So we've got that. But we've got 2 more conditions. The whole reference candle setup is 3 conditions. We've got 1 of 3, so we need another 2 conditions here. So what are the other 2 conditions? So the second condition's been met. Okay, the second condition is simply taking out the reference candle's low. Okay, it's simply taking out the reference candle. We've got that. Let's draw that in. We've got that. Okay, let's make this black. So we've got that. So now we've got 2 out of the 3 conditions. Now this is the key. This is the key. The third condition is everything. Without the third condition, you've got nothing. So this is what you've got to watch here very carefully, right? Do we get the third condition? The third condition is closing below the reference candles, low. So at the moment, we do have that third condition in, but it is marginal. So the closer the close is to the low. Sorry, let me just get this back. The cash market just opened. My system goes a bit weird then. But so if we get some bearishness and we get a close like that, well, that's the third condition. Okay, that's the third condition. Now I'm going to mark this black as well. Now, what's the big deal about these reference candles? And this is where the difficulty comes in. Okay, you need these 3 conditions for a swing. For a meaningful swing, you will always find these 3 conditions. Now, the 3 conditions don't necessarily mean a meaningful swing. There's the difficulty. So listen very carefully. For a meaningful swing, you need the 3 conditions. But if you've got the 3 conditions, it doesn't mean a meaningful swing. So we've actually got the bullish 3 conditions over here. So here's the bullish 3 conditions here. Okay. It does. So we may have a meaningful swing there, but I don't know if we're going to have a meaningful swing there. Okay. Now let's take a look at the sell down over here. Let's take a look at the sell down over here. Here's the first. Okay, this was a little bit more complex because it evolves over 4 candles, but there's where the third condition gets, and then we have a meaningful swing down. So anytime you're going to, if you show me a meaningful swing, I will find those three conditions for you. So now let's just add this to the analysis. We've got an uncertain 2 weeks, which I've deleted. We are at a technical 62% retracement. I'll just add in the 62%. We're at a technical polarity level, support, turn, resistance. We at a fundamental level with high uncertainty, okay? So we are at a very important point which can sort of make or break us, to be honest. So if the bearish conditions unfold, you know, we do want to get that third condition in. So watch for that very, very carefully. So that's the weekly analysis. Let me just take a look at some comments here, and then I'll come back to, and then we're going to go down to the daily. Yeah, so Shadrach is saying, well, you know, we've combined the two. Can we combine the three? You can combine three. I mean, the point is you can combine as many as you find useful. You know, I've always, when I originally was exposed to the combination of candles, Shadrach, it was generally combining two candles. On the odd occasion, I've put in three. But as you say, even if you add in the third candle, it's not really going to change much because it's really within the range, isn't it? We're still going to get that doji. We're still at that uncertainty at that 62%. The reason that I think the reason that we have integrated 3 into 1 or 2 into 1 is really to get a feel for the sentiment in the market. And I think that after 2 really important bounces, what we can deduce is that we are uncertain. Uncertain markets are dangerous, especially in a bear market, because they could be bear market bounces. Bear markets don't cause the damage, it's the bear market rallies that cause the damage, the dead cat bounces. Look what we've got here. Peak, trough, lower peak, lower trough. Is this going to be the next lower peak? We are in downtrend. Okay, this is downtrend stuff. So the likelihood of a continuation downwards certainly must be acknowledged. Is it a certainty? No, there's no certainties in this game. Okay, there's only probabilities, and that's what we're trying to assess. And I think that the 62% uncertainty does give us a certain downward bias. Just to put a completion on the weekly before we go down, and I think, Raj, this is something that you should look at, is just, do we get a higher trough here? I'm putting it as a question mark, okay? Because that would obviously be something that would be against your short there. So just keep an eye out for that. All right, let's go down to the daily chart here. So I'm going to go here now. I've got to just be careful. This is the Dow. I want to go to the DAX. Okay, now this is the DAX daily chart. What we've got here is the 3 zones, and on these 3 zones, it gives us kind of a map as well to read sentiment, and we can do that on what's called an absolute basis and a relative basis. Now, I'll explain what I mean by that. First, let's talk about on an absolute basis. So we've got 3 zones. We're going to call this zone 1. Zone 1 being the bullish area, zone 2 being a neutral area, and zone 3 being the bearish area. Okay, so you can see that this this capitulation, yeah, it had to take place in zone 3. Okay, it has to take place in zone, because that's the weak area. I'll see if I can find a strong area. It has to take place in zone 1. Where are we now? Well, we're in no man's land. We're in zone 2. Okay, we're in neutral. That's absolute. That's when we talk absolute basis. Okay, but when we talk relative, well, where are we relative to where we were? Where are we relative to where we were? Well, we were in zone 1. So we were in the strong area. Where are we now? Well, now we're in neutral. So neutral relative to strong, well, that's a step backwards. That's weakness. It's zone 1 into zone 2, that's weakness. Zone 2 into zone 3, that's weakness. So we've got to see if we fall back into zone 3. If we go from zone 2 to zone 1, that's strength. Okay, that's something that we've got to monitor as well. Now, I can see there's some questions. I'm going to come to the questions in a moment. Take a look at the Bollinger's themselves. What's happening to the Bollinger's here? What's happening to the Bollinger's here? They're starting to squeeze. Okay, they're starting to squeeze. So what that is implying is that the volatilities are starting to tighten up. Bollinger theory states that the squeezes leading to expansions. In other words, we would expect some sort of volatility increase to take us here. Now, where Bollinger theory is a little lax, and I wouldn't call it lax, it just doesn't really, the squeeze in and of itself doesn't tell us which direction, the expansion is going to be. Is the expansion going to be up into zone 1, or is the expansion going to be down to zone 3? We have to use other tools to make that kind of assumption. And I would suggest that the 62% uncertainty here, the squeeze on the Bollinger's, the movement from zone 1 to zone 2, all looks quite scary as we come into the squeeze. Does it mean that we're absolutely going to shoot down? No, there's no definites here. There's only probabilities. But it seems to me that the odds are shrinking for the next leg down until we get the higher trough here. We get the higher trough here, then the analysis has to change. Right now, okay, we just want to watch the squeeze, and given the uncertainty on the fundamental level, given that I don't think the supply shocks have really been reflected, and the supply shocks are now being exacerbated by the containment of a new outbreak in China. So there is a lot that the market is dealing with, and we're still looking at a Fed that potentially makes a policy mistake here. I think we'll end off this with a policy mistake. I just want to go down to the hourly. Before I go down to the hourly, I do see there's some questions here. I just want to go to the questions. Okay, Howard writes, do these need to be present on the weekly, or are they still valued on the daily, 4 hour, 1 hour? So I would expect that they would be, hey Jan, morning, nice to have you on the webinar. I would suggest that you can adapt any analysis for any time periods. I suggest you can do that. However, what I like to do is, I want it to make sense I want to try and get the technicals to reflect on fundamentals. I think that's very important. Number 2, okay, is that do some testing. Don't just assume it's going to work. Okay, just do some testing. Make sure, yeah, the three conditions would work on all time frames. However, so the 3 conditions must be present on all time frames. Anytime you get a swing, you'll get those 3 conditions. But this is vital to understand. How the closer we get to the tick, the more random the price movements. So you can get the 3 conditions up, then you get the 3 conditions down, then you'll get 3 conditions up, then you'll get a swing, then you'll get 3 conditions up, you'll get a swing. So the lower the time frame, the more random the signal. So just make sure that you understand that if you want to use it for sort of a scalping. And by the way, when we do the NFP, we do use the 3 conditions. These often, the last 3 NFPs, we've actually been stopped out. So what have we done in those NFPs? We're using a 1-minute chart. We're so close to the price action, it's very, very random, right? But the idea here is then it all comes down to stop loss management. All comes down to stop loss management, and the last non-farm payroll was on Friday. That video is available on our website or on our YouTube channel. And we really did, in my opinion, I think we did really good stop loss management on that trade. So please go and take a look at that. Yeah, I'll definitely put this on Telegram. Let's just see, Michael. Shouldn't the aqua horizontal line be on the low of the red bear candle? Hang on, Michael. I'm obviously too far beyond that. Let's just go see what. Sorry, Marco, just explain the question again. Shouldn't the upper horizontal line be on the low of the red bear candle? Over here, is that what you're referring to? So okay, what I'll do is, okay, Michael, I'm going to come back to this. Let's just do the hourly. Let's do the hourly just to get a full picture for the full top down, and then I'm going to come back to your question. I won't end the webinar before we've answered that question. Okay, let's go back to the hourly. So first of all, let's just understand where we are in terms of the sentiment. So we're at a 62%. Does that 62% have any magical qualities? No, you're going to have a hard time convincing me. However, I would agree that it's a self-fulfilling prophecy because a lot of traders are looking at it. So that's the first thing. So we're kind of at the 62% here. We combined these two candles. So we've got an uncertain environment. Technically at that 62%, guess what? We've got an uncertain environment on the fundamentals as well. So there just seems to be a reflection here. Raj, just keep an eye on this close. Can you see that close is eking up a little bit? So just keep an eye on that because we want the three conditions here. Okay, those three conditions must come in if we're going to have a capitulation here. Now, if we go down to the daily, okay, we've got a relative movement from zone 1 into zone 2, relative weakness. Even though on an absolute basis we are neutral, on a relative we've moved down. We're getting a squeeze on the Bollingers. One more thing just to mention about Bollingers is that John Bollinger does make provision for false signals before the expansion. So having something kind of move up with the expansion before down is something that Bollinger does talk about, but you know that's not going to help us one way. We're going to be whipsawed. But I just my feeling is that 62% in a time when we're still seeing these supply constraints, these stagflationary pressures, and overzealous Fed, gee, it's really kind of nerve-wracking, and we just want to see if we slip. Okay, go through to the hourly chart here. All right, so now you can clearly see there's some bullishness moving in onto the DAX. So for us, the R1 now becomes, I think, a crucial level. So we can just put in a resistance here. I'm going to just move it slightly up just to line up that R1. And you know what? Just to be complete, I'll add in the 50% FIB. So we've got a triple confluence at this R1. We've got the polarity principle, support turning resistance. We've got the R1 level. And of course, we've got a 50% FIB. That makes R1 a key level. I feel that if we go above that, there is a bullish sentiment to end the week. However, it really comes down to the signals, isn't it? So if we get angular separation to the northeast, well, then the bulls maintain. However, if we hit the triple confluence, we turn down, we need the EMAs to turn down. We need the stochastic to turn down, and then potentially the shorts pay off, and then it must come down to the 20 area. So this is now on an hourly. This is the key level to watch, in my opinion. Let me just see another question here. The long-term frame does not represent the daily swings, which these days are massive. We can get a sharp sell followed by a sharp buy in the same day. Any way to see why? That is a terrific question. My initial reaction, Jan, is probably not. I'm going to. So what Jan is effectively saying is, how do we cope with the enormous volatility that's hit the market? So I think the way to answer that, Jan, I think the way to answer that is, well, we've got to ask ourselves, well, what is volatility? Okay, what is volatility? Now, that sounds like such a sort of large, almost obtuse question, but I actually think it's actually the key answer. Okay, volatility. Let's put it up. Let's bring up Microsoft. Bring up Microsoft Paint. Okay, what is volatility? So I'll just put, what is volatility? Let me see if I can spell this correctly. Volatility. What is volatility? Because that's what Jan is asking. He's asking, how do we account? How do we factor in this volatility? Well, I'm not sure we can, because volatility is standard deviation. Okay, that's what standard deviation is. Okay, well, what is standard deviation? Okay, what is standard deviation? Well, standard deviation is risk. Okay, what are we seeing? So high volatility, what is that? That's high risk, and that's the whole point. What is high risk? What is high risk? Okay, that's high uncertainty, and that's the whole point. That's what we're getting down to. Okay, we're in this highly uncertain environment. That's exactly what we're trying to suggest here. When we combined on the weekly these two candlesticks, what did we see? We saw that uncertainty. What is that uncertainty? That's volatility. What is volatility? That's standard deviation. What's standard deviation? That's risk. And by the way, it seems to be coming to a sort of a squeeze now. So that probably, you could probably expect that to expand at some point, Jan. Now, the question is, can we take advantage of that? And well, we can only try and sort of play the odds, right? It seems that there is some sort of uncertainty at a key level on a large scale. We still need the third condition. The third condition is eluding us at the moment. We need that third condition. But okay, if it slips into zone 3, we get that expansion. Okay, that uncertainty, that high volatility probably favors us, as long as we've got a risk management stop loss strategy in place. So I'm not sure that we have to be nervous of it. I think as a trader, we probably want to embrace it as long as we've got a stop loss strategy and a risk management strategy in place. I hope that makes sense. Okay, Howard, no worries. I think, is there anything I've left out? I just want to end off with the Fed. I think I said I wanted to end off with a few things. I think I've covered most things. All right, just with the Fed, the Fed's being exceptionally aggressive. And I think that's open to policy mistake. We have looked at this on a model once. What happens is when you get supply shocks, and that's what we're getting right now. We're getting these supply shocks. There is effectively less of a product out there, but the demand's the same. So if there's less of a product out there, but the demand's the same, it becomes more expensive because the product becomes scarcer. So that's what a supply shock does. Monetary policy is not equipped to deal with supply shocks. It's just not. It's equipped to deal with demand. So if you're getting a supply shock and they are trying to fix it by influencing demand, that's a complexity. Okay, that's a complexity. Okay, that's a complexity that is ripe for a policy mistake. Not only that, okay, quantitative easing, which is effectively what the Fed used to, as we moved into the pandemic era, that is very much an unconventional, experimental type of monetary policy, and it has had unintended consequences. What's the unintended consequences? Massive inflation, compounded by the supply shocks. The margin for error was always going to be high there. Okay, so yes, it looks as if the Fed may have lost credibility. How did they lose credibility? Because they maintained a character of transitory, or they defined inflation as transitory, when the market was certainly of the opinion that it was more sustained. And they maintained that definition until it was obvious that it wasn't transitory, and by that time it was too late because inflation was now really rampant. And that, I think, is a consequence of two things. I think that's a consequence of the unintended effects of quantitative easing. Number two, the Fed changed in 2020 from an absolute target of 2% to an average target of 2%. And then, even of itself, I think introduced a complexity that perhaps they underestimated. In other words, to try and average an inflation of 2%, you're going to let inflation run hotter than normal if you have consistently missed, which they have consistently missed. So having those two kind of variables kind of interact with each other was a mistake. At the same time, there was huge government spending, so there was just this perfect storm for inflation. Right. So what's the Fed going to do about it? Well, they're going to embark on what's called quantitative tightening. Well, what's quantitative tightening? It's the flip side of the same coin. It's an uncertain, untested monetary policy. So the scope for error here must be acknowledged as well. It has to be managed exceptionally carefully. So there is a real risk of unintended consequences here on a number of levels. Number one, the market, to me, has an addiction to liquidity. The Fed's about to drain liquidity out of the market. Okay, so they have to manage that very, very carefully. Number two, okay, and this is something that is I was thinking about yesterday. They've got about $3 trillion of what's called mortgage-backed securities. Okay, they've got something called mortgage-backed securities, which is a long-term bond, effectively. Now, mortgage-backed securities are complex instruments. What happens in if someone buys a mortgage-backed security, they are exposing themselves to one of two types of risk at a time, and that risk can morph, it can evolve. So they're going to expose themselves to contraction risk. I'll explain that in a moment. And they're going to expose themselves to extension risk. Okay. What are we talking about here? So contraction risk is as follows. You buy a bond, a mortgage-backed security, because the interest payments on it are going to be pretty good, okay? So you're expecting to receive money for a certain amount of time. Now, if rates are coming down, people are going to refinance to get lower rates. So if a mass amount of people are refinancing their mortgages, well, that means your mortgage-backed security all of a sudden contracts. So instead of you getting the amount of money you wanted for X amount of time, it comes in a much shorter period. So that's what contraction risk is. Well, at the same time, you've got extension risk. If interest rates are going up, and they are, okay, that means people are going to start delaying payments, defaulting on payments. The chances of you getting your cash back extends out now, okay? So that's what a mortgage-backed security inherently has. It has two types of risks. Now, you can manage this, by the way. You can manage this in, you can do what's called time tranching, but I don't think the Fed has actually accessed time tranching because they're very specific securities. They're very specific vehicles to give you time tranching. So we've got the Fed, in my opinion, facing extension risk. Okay, got the Fed now facing extension risk. Okay. that exacerbates. How does that exacerbate? Because if interest rates go up, what happens to the prices of the mortgage-backed securities? They're going to come down. So now the Fed's getting exposed to risk on two sides. Income risk, so the income is now at risk, and the capital gains are at risk. And now it's tightening in that environment, okay? And guess what? The housing market is 20% of American GDP, okay? So you've now got a Fed that's going to have to manage how they tighten, holding $3 trillion of mortgage-backed securities that they don't add to extension risk or any sort of capital gains risk at a time when supply is starting to shock, okay? They haven't got the tools to deal with supply shocks, okay? And this is the type of environment that we find ourselves in. At the same time, okay, there's geopolitical crises which are affecting risk premiums. We're on a very, very rickety fence at the moment, okay? A rickety bridge. I'm not sure how to get from one side to the other, it's hazardous. And that's kind of where we are right now. What does that all mean for us? What does it all mean for us? Comes back to this. 62% retracement, uncertain environment. Okay, do things clear up? Do we get out of the fog, or do they continue to exacerbate? And that's where we are. All right, I'm going to leave it there. If there's any questions, please go ahead and type those in. Any questions? Okay. Thank you, Raj. Thank you very much. All right, I'll pop this on the the three conditions. I knew there was something else, Michael. Okay, sorry, just before we wrap up, I did promise Michael we'll do the three conditions. So I'm going to do this on Microsoft Paint again. All right, sorry, I don't know if you guys can hear it. So there's a duck that is. Okay, so Michael, you've basically listed this way. 1, 2, 3. Let's go one more down. Okay, and we go over here. All right. So look what we've got here, Michael. Okay, I'm going to do this. I'm going to do this twice. Okay, so where's the turning points? Okay, so you've got two turning points here. You've got turning point 1 there, and you've got turning point 2 there. So how do we measure the turning points? Well, we're going to use our reference candles. So take a look here. You've got condition 1. So you need for a bearish turning point, you need the lowest low in at least 3 candles. Then you need price to take out the reference candles high. Okay, and you need so candle 1, candle 2, candle 3. You need the third candle to close above it. Once you've got those 3 conditions, we have a swing. You see that, Michael? Now, opposite for a bearish reversal, you need the highest high of these 3 candles. Okay, you need price to take out the reference candles low. Okay, and you would need price to close below that. Okay, so that's kind of the theory behind it. Does that answer the question there, Michael? And that's why we're putting the horizontal. The horizontals are in reference to the reference candle. What's the reference candle? That reference candle is either the candle with the lowest low in 3 candles or highest high in 3 candles. You see that? Okay, so Michael just wants us to go back to the chart. He just wants us to see it over here. So okay, so the thing is here, the reason that this is confusing you, Michael, because this is actually a complex. This is a complex reversal. This is not in 3 candles. It's actually done in 4 candles. Where I think the confusion is, I probably had it at the wrong place. It should over here is probably the correct place to put it. So here you've got the condition 1. Okay, here's condition 1. Now we had condition 2 here. We had condition 2 here, but we didn't have condition 3 on that candle. So what I usually do, you can leave it like this. That would be fine. But what I usually do is I just drop this to the next low because I want the bears to prove themselves. So then I make it more sort of difficult for them. I make it that they have to take out the lowest low in the cluster, which happened over here. And that was the third condition, the way that I read it. Does that answer the question there? So instead of a 3-candle cluster, yeah, this actually turned out to be a 4-candle cluster, and there can be more. These can be quite complex, especially if you get a long candle like this one over here. This is a long candle, because what happens if you start having a whole lot of candles inside of the long candle? You understand? And then it becomes more complex. I'll leave it for another day though, because I think we've done a tremendous amount this morning. Any other questions, guys? Not tomorrow, Monday. We'll be on again Monday. We'll be on again Monday. All right. Cool. I think let's wrap up here, guys. And thank you very much for joining me. Have a good day and weekend ahead. We'll chat on the other side. Thanks very much.